What's interesting is that we women, we're good at earning money. If we do go out there and do that, we're very good at saving money. And yes, sometimes we're also good at spending money. But when it comes to planning our money or taking those financial decisions, for some reason, we always shy away from that. And it is something that a lot of people have now started to come out and think about, especially with the last year, all the uncertainty that surrounded the year. An important lesson that we have learned is that life is unpredictable, and that's why we need to be ready for any eventuality. And to help us today with financial planning and getting those right decisions, it brings me great pleasure to introduce Jagariti Mathur, who is an experienced financial professional. She's a chartered accountant from India. She's also an associate management accountant from Australia. A little bit about her is that after 10 successful years working in the corporate sector within the finance division, she started her own accounting and consulting firm called R Accounting Solutions in Singapore in the year 2016. And since then, she has helped several individuals and companies with their financial and accounting needs. So Jagariti, welcome to My Voice.
Thank you, Neera. It's a pleasure being here, and thank you, ladies, for being here. I would like to start this discussion with a quote from Coco Chanel that I really like. That for ladies especially, we need to keep our heels, head, and standards high, and that's what financial planning helps us do.
What is financial literacy? We do hear a lot about, the term financial literacy. So what does it actually mean? And why is it so important for women today?
Okay, so first let me answer the first half of your question. What is financial literacy? So in layman terms, financial literacy is nothing but the knowledge on how you can plan your money and your expenses better so that you have a very comfortable future, a very comfortable retirement, a very comfortable and independent life. This is what financial literacy is all about. The knowledge of how to save, how to invest, and how to be comfortable. And most importantly, how to protect the wealth that you have accumulated. That is financial literacy. And now to answer the second part of your question, why is it so important? Especially for women. So what we have seen is that we are great homemakers, we are great professionals, we are great mothers. But when it comes to financial planning, some of us, we get a bit scared. That, our husbands or our fathers or someone else is taking care of that. Why should we get into it? We kind of get intimidated with the financial figures or like plans and investments and stuff. So I want to say that it is a very important aspect for a woman's life because first, you can have an independent life, right? You don't need a Prince Charming to do things for you. You are an accomplished woman. Do it yourself, right? Then what the second aspect would be to have a stable retirement, to have a fund ready for you for a rainy day, to have a secured future, to be debt free. Because as you say, maybe some of us are business women, some of us may have taken some property loans managing our kids' educations. In different aspects of our life, we tend to sometimes have some debt on our head, but we don't know how to plan for that. If you plan for your debt, then you can have a debt-free retirement or a debt-free future. To have that, you need to have a secured financial planning to increase your ability to take risk. If you want to start something new, your things that, we have so much loan. I have so many responsibilities. It doesn't harrow you down. It doesn't pull you down. So have that free life, plan it, and then to leave a legacy for your kids. See, we all have a short span of life. Let's be clear. And after COVID, I think everyone agrees to it. We don't know what happens next. So it's very important to have that security that if something happens tomorrow, you can pass on some, you can secure your kids' future, pass on some property or some money to your kids so that they can have a good life if something happens to you. So that is why financial literacy is important. And especially for women, because they are the educators in their family. They are the ones who can bring that change in the family. It's very important for a woman to be a financial literate. We are better halves. We call ourselves better halves. Then let's be those better halves. In fact, we can guide our husbands, or we can help our fathers, or anyone who's in need. Why burden one person in the family with all the decisions? Help them.
Correct.
Be a
Correct.
financial
And even if we are on our own, well, all the more reason, because then there is nobody else to do it. So you have to stay honest.
Also, Neera, in Singapore, there are a lot of these women who get married and come to Singapore, and they're homemakers. And there have been so many cases that they've been abandoned by their husbands, and they have absolutely nothing in their hand, either to go back or way to fend for themselves. So because they're not financially independent, that's been the case in Singapore, and we're listening a lot more in the expat community.
Yeah, so that's one more reason. No, one more reason. Be a financial literate so that you know what to file for your divorce petition. Helps to know all the assets in the family.
Absolutely.
Well, exactly. I mean, look, we hope nobody ever comes to any of these, but we all have to be prepared.
Absolutely.
So, Jagariti, my question for you is now, okay, so now we understand that it is important for us, right? But how do we know what is right? How do we make those effective financial decisions? What are some of the things that we should be looking at to be able to take the decisions? And of course, for everybody, based on their situation, decisions should be different. But what would you say are some of the basic things that we should be looking at?
First, I would say it's a very interesting question, Neera, and I've prepared a small presentation. If you allow me, I would like to share. Steps that we need to take, right, for a secured financial future starts with this. Can you move to the next slide here? Yeah. So steps for effective financial planning are: first, set up your financial goal. Understand what is your financial goal. What is that you need, right, for your future, or what are your requirements? That is the first step. Set up your financial goal. Set aside a fixed sum of money according to your financial needs. And third, evaluate the options which are available in the market. If you allow me to go to the next slide. Yeah, so let's discuss these three in detail. First, set up your financial goal. How can you set up a financial goal? What is a financial goal? Financial goal is how much money would you require after a number of years to be comfortable in life. So what you can do in that is, first, budget your earning and expenses. See, we all are working women. Some of us are entrepreneurs, some of us are working, or some of us, even for homemakers, we know what our household income is. If we know our household income, we know our expenses, we need to budget them, that how much is that we can actually set aside. Then make a list of your current and future liabilities. You may have your kids' marriage on your head. You may have, for example, a foreign trip coming up for you. You may have to buy a house. You may have other things which you have to deal with, right? So just make a list of all your current and future liabilities. Make sure you have listed down everything so that you know what you need to set aside for. Project how much income do you require at the point of your retirement, or if you're retired, how much income do you actually require every month to sustain a decent lifestyle, or the lifestyle you want, right?
Just a second. I think someone is on. I'm unable to unmute someone because I think I'm sharing the screen. Neera, can you do it? No, I don't think you can.
All right. Who's
Bindu, can you please mute yourself? There we go. I think it's still on.
That's okay. So where were you? Project the monthly income you require at the time of your retirement. How much money do you exactly need to sustain a decent lifestyle when you don't have a fixed source of income? Then, most important thing is set a contingency fund aside. What is a contingency fund? A contingency fund is the amount of money, right, for rainy day. Basically, if you don't have any income and sudden expenses come over, then that money can be used to set off those expenses or liabilities. This is the first stage, that is setting up your financial goals. Okay, now let's move on to the next slide. Okay. So what do we have to do? Set aside a fixed sum according to your needs. What do we mean by this? Set aside a fixed sum every month for investing. That is, after you have set aside your contingency fund, after you know that, okay, this is the amount of money which I can spare, or this is the amount of money which I want to invest. There's a difference between the two. I would actually go for the second one, that fix the amount you want to invest and then adjust your expenses and saving and income, Then make sure that you have at least 2 to 3 months of your monthly expenses saved as a contingency fund on a yearly basis. If you have at least 2 months or 3 months or at least 10%, 5 to 10% of your income saved as a contingency fund, then you're in a good position. Can we go to slide 3? Evaluate the options which are...
Jagariti, a quick question on the previous slide. So what you're saying is first assess what your monthly expenses are, because a lot of times we don't know. We just pay the bills as they're coming along, the mortgage or rental, which is probably the biggest chunk, kids' education, your groceries and whatever else expense. So what you're saying is start looking into all of these expenses. Start noting them down, over a period of couple of months, because some months are more, there's more expenditure as compared to others. So have a look at those expenses, average it out, and contingency fund, according to you, it should be at least 2 to 3 months of your total expense.
Absolutely.
So from the money that you're saving after paying everything, make sure you have all the savings that you have been accumulating, have that as your contingency amount. So keep that aside, like, where bank account or anything. And whatever else is left, what you're suggesting is should be something that then you can look at investing.
Absolutely. And thank you.
And so the contingency fund is probably not earning us a lot because, interest rates are generally not so great in a fixed amount or savings account and things like that, but it's still going to make us some money.
So, it'll make some money for you, but the whole idea of contingency fund is not to make money on that fund. It is a rainy day fund, which you should have in case things go wrong. So that is the fund which should be there with you.
Yeah, and so it should be a type of an account where it's readily available.
Absolutely.
Got
it. So even you can make best use of this contingency fund also. You can put it in instruments which are ready cash, which are in the form of ready cash, that is can be easily liquidated. You can put it in that also if you want. But
got it. And then of course the rest, what you're saying is something that is then used for our investments.
Yes. So
now when we're talking, so now next what you're talking, so now you're going to actually tell us a little bit more about the different places where money can be.
Yes. So now I'd be telling you about what are the options which are available in the market, how we can put the money, what are the instruments available in the market. So first instrument which is available in the market and which we all know about, which is a common knowledge, is deposit with the bank. And deposit with the bank does not mean your saving bank account or your current account for your company. It means reoccurring deposit or fixed deposits which have an interest rate attached to it. That is, your money while sitting in the bank can still make some money for you. So fixed deposit, we all know, is you put it in an FD, it's for a couple of months, a month or so, you decide the tenure, there's a rate of interest attached to that, and you get that at the end of your tenure, right? Then the second way is reoccurring deposits. So reoccurring deposits are that you put your money monthly in this deposit, they give you a particular rate of interest, and you can withdraw this money anytime you want. It's a short deposit, for like 6 months or so, and then you can keep on building up your money. So you don't have to put a lump sum. It's just a monthly way of contributing and building up on your fund in the bank itself. So for deposit in the banks, you can use 2 options, either fixed deposit or reoccurring deposit. So ladies, if you're not clear, please raise your hands, ask any questions, anything. Are we clear?
So I'll ask a question if nobody else has a question. The rate of interest for both of them will be different.
Absolutely. Rate of interest for both of them would be different. Definitely. But FD, of course, gives a better interest rate because it's fixed, not flexible. Good. So anything which gives you more flexibility gives you moderate return, not as compared to the fixed one.
Yeah.
Second option that is available in the market is mutual funds. We have all heard this term. We all know that, our husbands or brothers or fathers all talk about, this is SIP, this is a mutual fund, this is good, that is good. But what is mutual fund? Can anyone tell me? Anyone knows what is mutual fund? Any one of us, ladies? Anyone who knows what is mutual fund? No? Can I tell you what is a mutual fund?
Please do.
Okay. Mutual fund is nothing but a pool of money. So they collect money from all the investors. They give it to good fund managers who have idea about how the market works. And then they invest that pool. From that pool, you guys get dividends. The form of income is a dividend. Then there are various options in which these fund managers invest the money. And according to the options they exercise, whether it's risky, moderately risky, or highly risky, you get that return. For example, if your manager says that, okay, I have XYZ fund, and we invest in bonds. So bonds is a very less risky option. So when they invest in it, you get that fixed rate of return, you get that fixed amount of dividend, which you can withdraw. But it won't be really high. So especially for those who are retired or who want to plan their investments in a way that they have that fixed monthly component, they can choose that type of SIP or fund that they want to go into. And at the same time, if there's a person who is into a high risk bracket or who wants to really invest in the market, want to go for a high risk option, then there are various options in which these funds vary. And the beauty of mutual fund is it is highly liquidable. That is, you can withdraw. There's no lock-in period. You can withdraw anytime you want. But of course, there are some conditions, there are some charges which a financial planner, when they discuss with you according to your needs, will advise you in a better fashion. Okay, are we clear on that? Are we clear with mutual fund? Done? Can I move to the next option?
Yeah.
Okay. Next option is government saving schemes. So the beauty about all the governments are they have got these wonderful saving schemes. For example, for those who are in India, they have something called PPF, where you put your money, get a desired rate of interest, and then you get out. Right? For Singapore, we have CPF. The same, you put your money, you get a desired rate of return, but you can only withdraw the money later at the time of maturity, 60 years or so. But then they have SRS, right? Supplementary retirement schemes, where you can add more money, invest that money. That's a separate scheme, but a beautiful scheme where you get fixed rate of interest. Then another option is your investment and insurance plans. So I would like to talk more about the investment
Jagariti,
and insurance plans. Yeah, sorry.
Also, I believe in Singapore for the CPF, you can also use it while you're still working and you've not retired, or you're not, I think, whatever the age of 65, and you can use it to fund your primary property, correct? And other investments.
Exactly. That is what we are going to discuss when we come to our property purchase area.
Jagariti, I also wanted to ask, like, there are a lot of housemakers in our group. So the CPF only comes for the people who, if they're working and a certain amount of percentage that gets cut. So what do they do if they have to invest in CPF, or they have to build that from whatever savings that they do from their, which they get it from their husbands, or how do they do that?
So specifically, if you talk about Singapore, they have something called voluntary contributions. So if you are a resident or a permanent resident in Singapore, you can voluntarily contribute to your CPF in the form of MediSave or other plans. So that option government is already giving you. And then even if you are not a PR, you can invest in the CPF using SRS scheme. That is called a supplementary retirement scheme. In that, your X amount of money is invested into Singapore bonds and CPF schemes. And then you can also use this money if you want to invest on your own in other markets. So other than CPF, if you're a homemaker and you really want to make that investment, you can use SRS, Supplementary Retirement Scheme. And if you're a PR or a Singaporean, then you can make voluntary contributions to your CPF. That is something which the government allows. So that's how you can invest in CPF.
So, Jagriti, I have a question. Because I stay in India, is this something similar to NPS here, National Pension Scheme?
Yes, somewhat similar to that. Somewhat similar to NPS.
Yeah, okay. We do have equity-linked options there in NPS too.
Yes. So SRS is similar to NPS, where you invest the money, and then you have the option to reinvest it wherever you want, in bonds or equities, wherever you like. And it's a very return-based market-based return that you get.
Yeah. Okay. Thank you.
No worries. Any other question? Anything else? Okay, so can we move on to our next option, investment and insurance plan?
Yep.
Okay. So for investment and insurance plans, can I ask everybody a question? How many of you are insured here? Anyone who is not insured?
I'm not.
That's great. Okay. Umaji is not
I'm
insured. Anyone else?
Yeah, and I have a reason. I'll tell you when everyone finishes.
All right. Super. So okay. First, I would like to say that insurance is great and a necessity in these days. So Umaji, maybe you can think about getting yourself insured. I don't know your reasons. Maybe we can discuss that later. So for investment and insurance plans, there are basic divisions for various insurance plans. Okay. First division is health. Then you have term. Then you have endowment plans. And then you have your retirement or child education plan. So we are going to touch base on all these options. Okay. So let's talk about first plan, which is your health plan. Under your health plan, you get yourself insured for any health related issue. That is, it is not you, but your insurer who's going to pay. The insurance company is going to pay your bills. There may be a cost sharing 5% or 10%. So basically your health related liability, right? Your health related expenses, they get reduced by and far because of your health insurance. It depends upon the terms, it depends upon your existing conditions, but health insurance is something which I would recommend you all should think about. Right? Second type of insurance is term insurance. Term insurance is your life insurance. So basically, this insurance helps you to leave something for your family, even if you are not earning. Because if, God forbid, something happens to you, right, your relatives or your family gets a lump sum amount of money from the company. It is just a small amount of premium that you pay, but it gives you a big benefit. Not you, but your family. So one of the ways you can leave a legacy for your family, even if you're not earning, even if you don't have large bank balances. It's just a small commitment every year. Third type of plans are endowment plans. So the beauty of endowment plan is that it is your life insurance plus your saving plan. What happens with the endowment plan is that it gives you an option to put that money put your money on yearly or monthly or whatever plan you choose on that basis. And after X number of years, if nothing happens to you, you get your lump sum plus some bonus back. So if something happens to you, the life insurance money is paid to your family. If nothing happens, you can take that money and enjoy. So it's your life come retirement plan. But the only, why I would not recommend an endowment plan is the rate of interest is very low. It's quite expensive, right? So what you can get with the term plan or just pure investment plan, you won't get with the endowment plan. But it is the most safest plan to have because although you are paying more, you get that money back with some interest. And if something happens, you get that life insured premium or life insurance lump sum, your family gets that money. So that is an endowment plan. Okay. Now, the fourth type of plan is your retirement plan or your child education plan or your investment plan, right? So these are the plans where you contribute yearly to meet your financial goals. For example, you need $100,000 for your kids' education. You start investing now and you build a portfolio so that when they reach the age of 25 or say 22 or maybe 18, they get that much amount of money for their education. Your retirement plan, you keep investing and then for 10 years or for 15 years, and after that you get that lump sum. Or if you want, you can also divide it on a monthly basis, that you can choose whether you want it monthly or you want to get a lump sum so that you have a comfortable retirement. So these are the plans which you should really, really think about.
So,
Any
John,
questions?
yeah,
Yeah.
I have a question. In terms of some of these things, now again, for everybody, how they want to invest and which all they want to invest in or park their money in, would be different because everybody's risk capability is different. But is there certain formula or percentage that, again, for the lack of better word, a standard way for people to do where they say, okay, well, 10% I want to put in this, 20% I want to put in this. How do we decide? Like, these are all wonderful things. How do we decide what is right for us? And if there's a percentage that should be invested in some of these?
No, unfortunately, it actually depends upon your income and how much can you spare. There's no fixed formula that I want to invest 10% in mutuals, I want to have 20% in insurance plans, 10% in government schemes. It does not work like that because it truly depends upon what are your needs and your risk appetite. For example, for a person who has just started his career, then maybe they want to invest more. They don't have much liability at their end, right? When you just start your career, you would want to invest more in mutual funds, more in high risk investments, or you want to get more into insurance or retirement plans than a person who's in middle of the career, right? Or just had a baby. They would want to invest more for their child education, want to invest more towards retiring comfortably rather than investing in high risk investments. Similarly, the one who has retired may not want to do any investment, may want to just deposit their funds in the bank in an FD, no insurance plans for me, nothing. I just want to put my money in FD and get that much percentage so that I can live a comfortable life. So it all depends upon the mindset and it all depends your needs, current and future, and the circumstance that you're facing now. And trust me, your plans can change every year. You can upgrade or downgrade them depending upon your risk-taking capacity, your income. Right. So there's no fixed formula there.
Got it. So depending on your situation and where you're at,
exactly
all of these things can change, and you can be actively participating in where you want to be.
That's what, right? It depends upon your financial goals, what you really want.
Got it. And so, just a quick question, sort of a side question. Are there people like, you hear about financial planners and things like that. Is that what they also help you with those decisions based on what your needs are and what your situation is and what your income is?
Absolutely. That's what a financial planner has to do, to suit and suggest your plan suited to your needs in your current situation. That's their job. But for us to be a smart investor, we need to analyze what are the products they are offering. As in, for example, I have a financial planner who has analyzed my financials and tells me, okay, I work for Prudential, I sell you Prudential. These are the products available. But maybe some other financial planner, say a Manulife or an Aviva, has a better product. But this guy is only an insurance agent, right? Then he wouldn't be able to guide you. So what kind of financial planning you require and what financial planner you choose is very important. And trust me, insurance agents are not great financial planners because they sell the products they are supposed to sell. So look for a financial planner who can give you an overall view. Or maybe especially for those who are in India, if you really want to invest in insurance, the beautiful thing is this policy bazaar, right? Just log in and see the premium and the benefits. And I think that is the reason why we women are a little scared. No, yaar, itna sara data, kaun padega? Chodo, jane do, kar rahe hain, karne do. But no, just think about it. Ek din lagega, par samajh mein aayega, what is that? Right? So we really need to be focused. Who will read all that literature? No, that doesn't work.
Makes sense. So even if, again, depending on how much time you have or how much you want to learn, you could do a lot of these things yourself. Absolutely. But even if you were to have a financial planner, because of course they have more knowledge and this is what their job is, it is important for you to understand all of these things. So then you're guiding them and they're guiding you, and it's a joint decision. It's not like, all right, I will give it to the financial planner, let them do what it is. And that's fine. Look, if you don't have the time or the bandwidth or the acumen, that's fine too. But it is definitely more sensible to understand this before you go out there and give your money to somebody.
Absolutely, because first, it's your money, right? Secondly, though it is in capable hands, but at least you need to know where the money is going. I'm not saying that you spend like hours and hours analyzing what the thing is. Nobody can, everyone has a role, everyone has the capability and capacity to do only X number of things. But once a year, just sit with that man and ask him, right? Okay, tell me, what have you done? Where am I heading to? Right? These are our financial goals. What has happened? So maybe a quick summary kind of thing in layman language, which he can make you understand, and you can get an overview of what is really happening. Because most of the financial jargons, unless you're part of the industry, you won't understand. And we really don't have time, right? But their job is to make you understand, to give you an overview so that you have an idea of what is happening to your money. That is what we are talking about here. Okay. So can I ask a question to all of you? Okay. So first I want to ask, who has understood what financial literacy and planning is all about? Have we understood? Do we have a rough idea? All of us?
Jagariti, I actually have a question.
Yes, please.
You're talking about financial planning. Do you do that? Is that part of your...
Yes, it is.
And when do you start? When can a woman start?
Selby, anytime.
I'm asking...
Any stage of your life.
All right. I'm asking because I have 2 young daughters who have, a certain amount as their pocket money.
Right.
Are they eligible to start? Because it will be good to educate them.
Absolutely.
Make them understand the importance of this.
Absolutely. So there is no certified age, right? That only if you are 18. So it's not like alcohol, only 21. You start at any age. Doesn't matter. Okay. So any age is good if you can, and it's not necessary that you have to spend thousands and thousands of dollars. Yeah. If you start at the right age, or even if you want to start early, $100 a month is good enough. Who understood what financial planning is about, roughly? Well, a bit, not completely, a bit. Yeah.
I have a couple of questions.
Yeah, we can discuss that. So Janice, it's just a simple question I want to ask, then I'll take all the questions. I have a scenario, and I'll pick any one of you or 2 of you, and you have to tell me, right, what do you think is the correct decision? Okay. So basically, there are 2 ladies, okay? Their name is Alice, and the other one is Benny. Right? So now I'll give you a scenario. You guys just tell me who's better. Okay? Who's well planned. So for Alice, she works for a software company. Okay? She has a good pay packet per month. We say $10,000. Her monthly expenses are very much similar every month. They don't vary much. Okay? She saves approximately 10% of her salary in her bank account for Contingency Fund. Okay. And all this money is kept in her bank account. No FDs, nothing, but just in her bank account as Contingency Fund. So basically 10% of her salary is her saving. Okay. We all got the scenario. Should I repeat it? Neera, should I repeat?
Yeah.
Okay. So Alice and Benny. Alice works for a software company, has a $10,000 worth of monthly salary, has a monthly expenses, has almost fixed monthly expenses, say around $8,000 or so. Okay. And she saves 10% of her salary as a contingency fund in her bank account. That's it. Okay. That's one scenario. All good? If you all understood, can I have a thumbs up? Got it? Yeah. Okay. Second one is Benny. She runs her own boutique. It's not a very big startup, a medium kind of boutique she runs. She has variable income. She cannot tell that how much money she is going to make every month. She has budgeted her monthly expenses. So she don't know about her income, but she knows that, okay, every month I have these many expenses. That's it. And she is able to save 5% of her monthly earnings, despite all her monthly expenses. She has budgeted them. She has a variable income, but on an average, 5% of her monthly earnings she is able to save. Out of those 5%, She keeps some for contingency fund, say out of that 5%, 2% is say for a contingency fund, and rest of the money, rest of the 3%, she invests in all these financial instruments, okay? FDs, mutual funds, insurance, whatever. So can you guys tell me, after 5 to 10 years, who would be better placed or who has done a better planning?
The second lady.
The second lady. Why do you think so?
Because, okay, her income might be less, but if she's using all the financial instruments, she definitely gets an interest, which could be from 3% to 5%. So even if she's saving like, say, 3,000, that 3,000 multiplies over the years into a better planning, whereas versus the other lady, after 5 years, would still have 5,000 in her account because it's only $1,000 a month that she's saving.
All right, great, Par. So anyone who thinks Alice is better placed, anyone, so votes for Alice. Who think Alice has done good planning or she's better placed than Benny? Anyone? No. So you all agree Benny is better placed, right?
So I have a question. Is Alice a safe investor?
Alice is not an investor.
Yes, she's not an investor, but a safe, I mean, she's played safe with her savings.
Umaji, she has placed too safe, no?
Too safe.
Yeah.
Too safe. Yeah. So
everything, yeah. So that's what we are getting at. If you don't invest, you are super safe, but then there is no income also, no? It's
yeah,
just
there are
that,
no returns, higher returns. Yeah.
so as we say, no, that money doesn't double itself on its own. You have to give it a nudge. So she needs to give that a nudge, get that nudge to her money, right? To multiply.
Jagariti, perhaps if you had asked this question initially, you might have gotten a different answer.
Yeah, I know, but I wanted to understand, everybody's saying, yeah, we got it. I just wanted to understand where are we placed now after all that discussion that we have had. So I just wanted to understand this one.
I think Warren Buffett has really put it very well. I've just put the quote over there. Do not say what is left after spending, but spend what is left after saving.
Exactly.
Save first and then spend.
Exactly. I completely agree. And that's the better and the best way to invest. Decide on your investment and then cut down your expenses so that you can have a better and great future. As I say, high heel, high head, and great standards.
I would just like to add over here. I was just viewing another YouTube video on stock markets, and over there, the lady said that when we were doing our commerce in college, there was a simple formula which was taught even in schools, actually, for that matter, in the profit and loss chapter, where they said income minus expenditure is equal to savings, but actually it should be reversed, where it should be income minus savings is equal to the expenditure. Yeah. A very simple formula to follow.
Janice, may I have your question, please?
I was wondering if you were going to talk a bit about interest rates, understanding interest rates, compound interest, whether it's interest rates in earnings or interest rates for loans. But understanding that, how to calculate it, how to understand it, the compound interest and so on. And using that when you're making your budget.
Okay, so when you're making your budget, let it be a simple one. Don't calculate a lot of interest rates and stuff in that. I know for calculating or making your financial goals, you need to take into account the loans that you have. But for a layman, right, that's what I said. For a person who's not from a financial background, if you go into the detail of calculating the interest, you don't know how accurate that would be. So maybe you take your loan sheets, right? We all have your loan statements. Just see what is the repayment amount that you have and then see, because ultimately it's not about the monthly principal repayment that you have to do. The ultimate goal is to repay that amount and at whatever age you want to. Right. So just take the final amount that you need to pay and put it in your financial goal when you're calculating that. For example, I have to pay 100K after 5 years. So after 5 years, I need to have this much amount or whatever is left, right, to pay. So you have your yearly statements, right? Use that. Don't try and calculate it because it's a very complex procedure. You may not calculate it accurately, right? So let the bankers do that for you. Access the statement.
Okay. Another quick question for term insurance. Is personal accident insurance also
part of term insurance?
No, accident insurance is not part of term insurance. Term insurance is life insurance. Accident comes under health, which is your health and personal accident insurance.
Okay, got
right?
it. All
yeah.
right.
So accident is personal accident insurance with death benefit, without death benefit. That goes into detail, which we can take it up later in a financial consultancy session. But that's not the same.
Okay.
Okay. Any more questions?
That's
Anyone?
Anyone? Jagariti, are you going to talk more about the investment options within Singapore? Like you mentioned about the voluntary contribution to the CPF and the SRS, but I believe for the foreigners, those are who are on DP and they work over here. What are the avenues are there? Because there are many ladies over here who come from outside, but they are not on neither. They are foreigners basically working here. So what investment options do you suggest?
So basically, SRS is open to all.
Okay.
SRS is open to all. CPF is something which is open only to the residents and PRs.
Yes. That's
so
right.
Still invest in SRS.
So that is the only option, is it?
No, there are also options. You can use the investment funds. You can use the mutual funds.
Mutual funds. Okay, the mutual funds is what I'm aware of. And the stock market over here also, you can just invest as any other normal investor.
Yes. So you have to have your demat accounts in place if you really want to invest into stock market. So the banks would be the bankers or the relationship manager, right? They would be he would be a better person, he or she, to guide you on how to open that account and deal directly. So now there's one more aspect that I would like to introduce to all of you, right? The next important step is protection of interest of your loved ones. So how many of you have a will or a trust, or those who are in business have a business continuity or a succession plan? Shika has. How many of us have? Janice has. Neera has. Anyone? Hasina, do you have a business continuity plan or a will or a trust? Umaji? Tatma? No one, right? So see, that's the beauty of it. Even if you've done a good financial planning, if you have not thought about how to protect that or how to allocate it, then that becomes a problem. That's why we have solutions like will, trust, and for business owners, a business continuity plan. So what is a will? Can anyone tell me what is a will? What is a will? Okay,
I can.
Okay, let's give chance to Hasina.
Yeah, that's right.
Okay. It's something that you'd want your family and close ones to have when by any chance you have an accident or you're gone from this world. For those of our family members who have no information of our details, of our assets, of our bank accounts, treasure, jewelry, etc., it's normally planned in a will where we will already announce our inheritance or dividing them to our family members, depending on how many number of children we have, daughter-in-laws, parents if you're still living, so you leave behind a simple will so that your assets and everything that you earn for is enjoyed by your family and the country or government doesn't take it over it.
All right, that's beautifully and well put, Hasina. That is what a will is. So that is something all we ladies need to prepare for ourselves. Details of our assets. What are our assets? So not only money, investments in the monthly pay packet that we get is an asset. For homemakers, right? Our jewelry, right? That is our asset. If there's any property in our name, or if we have any property share or a share in our name, right? From a husband's side or from our family side, anything, right, that we are to get in financial terms is an asset. So just prepare a will. Just put it down. Who do you want, right, should be in charge of your things once you're no more? And that is what a will is. And we all should have it so that there is no problem later. And in a lot of cases, frankly, it is seen, sorry, I'm giving this example, but my father-in-law passed away, right? And then we really had an issue with that because he had a will, but it was not registered. So a lot of these lawyers and all these things we can avoid, right? If we have a will in place. Transfer of bank accounts. It's really messy. If you don't have something like a will or a statement, It's really messy to get the transfers done. So have that will in place. It's the legal document stating that all of this belongs to this particular person after you're not there.
And also in Singapore, it is said that if for some reason there's an untimely demise of your husband, and if he doesn't have a will, there is a chances that they will freeze the account immediately. And only if you have a will, you can access their account. So if it's not a joint account, you are in a big trouble.
You're in big trouble.
Yeah. So make sure, your husband has a will, which is, where all the accounts, your investments, your assets, everything is included in that.
Included. True. Thanks for that, Shikha. Then the second thing is trust. Who knows what a trust is here? Anyone who knows what a trust is? Please raise your hand.
I don't have one.
Okay, Janice, please explain trust.
Okay, I just realized I would end up having to explain. A trust is when you, it's definitely for people who have wealth, who set aside funds to be provided for their beneficiaries, whether it's after a certain amount of time or their funds are just managed by a professional third party for the individual beneficiaries.
Okay. So thank you, Janice. That's perfect. So in layman terms, a trust is something you set up where a third person is in charge of all your property, and you say that, okay, if something happens or if XYZ conditions happen, then this money goes to a particular person. So it can be a legal entity or any other person. Okay, let me explain. For example, Mr. Sharma, right? He puts a trust in name, he opens a trust in name of his kids, that if something happens to me, this much fund, I have set aside $100,000 in that fund, which is to be used for my kids' education. So that fund can only be used for that kids' education. So trust is set up for a specific purpose. That if XYZ condition happens, then that money needs to be utilized for XYZ purpose. And the person who is in charge of the trust makes sure that the details or the conditions of the trust are fulfilled. So that is a trust.
How is it different from will?
No, will is, so will, you only get the things you cannot say that this money can be utilized for this purpose only. So in will, you later have XYZ things, and I want this to happen. This person is in charge, this is the property, this is what. And it only comes into picture once a person is no more. But that is not the case with trust. You can open trust for XYZ purpose. Even if you're living, right? You can say that, okay, I'm setting up this trust, but when my kid starts going to school, every month I want like $10,000 to go as a fee from this trust.
Okay.
So the condition for is not, so you can set up a trust even when you are alive. Okay. For a will, you need to die for it to come into execution. Sorry for my crude explanation. I just wanted everyone to understand. I didn't mean it to. Hope we all live long. Okay. The third thing is business continuity or succession plan. Who can explain what is a business continuity or a succession plan? Can I explain?
Yeah.
Janice, yay! Janice rocks. Oh, you can't hear you.
I want to attempt it, and then you can clarify and so on. Okay, so business continuity or succession plan, I think it can cover a few different things. One is you actually buy some sort of insurance, which covers the business being able to run financially without you, either in the money being spent on the operations or being spent to hire your replacement. Because the owner, you might not necessarily earn a higher income because it's your business and you don't, but in order to engage a professional to take over for you because you no longer, you've passed on, the insurance money covers the engaging to find a professional to take over the business to run it.
Great, you're right. So this is the purpose of a business succession plan, but there could be other reasons also and other things also which can be added to business continuity or succession plan. So as you said, that to hire another person or to have a business continuity plan to pay for your operational expenses. Not only that, what happens is, suppose you have a partnership firm, right? And the partner dies, and you don't want to onboard the successors of that partner, then you need to pay a lump sum to them. Then a business succession insurance plan or any business succession plan or savings that you have, you can use those savings to pay off full and final share of the existing partner to the third one. So there can be many uses of business succession plan. So basically, business succession plan is to secure any mishap in the business. Business succession plan can be to foresee and secure yourself for the losses or for the debts your company has. Because there may be a case, right, where you're in a partnership or you have a sole prop or whatever, you have taken loans from the bank. And let me remind you all, if you have taken a loan from a bank and you are a partner, right, your personal assets are also liable to be dissolved to pay for the bank loans or any debts that you have. So a debt insurance, all this is part of a business continuity plan to make sure that even when you are not there, your business is continued and run smoothly without affecting your personal assets and your family members. And there's something called key insurance policy, right, which can be taken. So key insurance policy is that, for example, you have a sales personnel who's getting like 80% of business for you, and he suddenly decides to like wrap up, resign, go, or goes absconding. Then you are going to suffer that much loss, right? Then a business continuity plan or a keyman insurance helps you to recover that much amount from an insurance company so that your business can run smoothly. So that is a business continuity plan. And the ways and insurance plans that come under is like business insurance or your succession insurance or key management personnel insurance, your debt insurance. All these are the insurances which come under business continuity plan. You can also have trusts. You can also make trust to make sure, as a part of BCP, right, a business continuity plan, that if something happens or XYZ happens, this is the fund we are setting aside, right? And then you can lay down the conditions, what would happen in different scenarios. So that is a business continuity plan, which all the entrepreneurs, I think, should have. I would like to end my discussion with one quote. That's it. She believed she could do it, so she did. And that's what we all have to do. Believe that you could do you could be a financial literate, do financial planning, and I'm sure you all will ace it. So thank you very much for listening to me.
Thank you, Jagariti, for such a wonderful and informative session that we've had today. And I'm sure audience today are going back with more armed with knowledge and courage to take charge of their finances, you know. Thank you, ladies, for joining today. And as I mentioned, the idea behind my voice was really to create a community where women can share, support each other in becoming better versions of ourselves. Both Neera and I have shared contact details. I'm sure some of you have already done so. So please, let's keep in touch, help, listen, and hold each other accountable.